You're listening to The Moose and the Loose, your 10 minutes action-packed financial podcast with your host, Mike Yahoo. Hey, what's up, Market Moose? Mike from The Moose on the Loose. Today, I am taking a break from Business Friday, and I'm actually answering a question from MNST Growth. I guess it's not his real name, but I mean, just joking. So, as you know, the podcast is also published on my YouTube channel at The Dividend Guy. And yesterday, I talked about my top 10 position in my portfolio. So rapidly, they are actually, because I haven't changed my portfolio overnight. So you have Apple, Alimentation Couche-Tard, National Bank, Brookfield, Microsoft, Costco, Constellation Software, Visa, Blackrock, and TELUS. And then when it was published on YouTube, I had MNST that asked me two great questions, and I thought, well, it would make a very good follow-up episode. So the first question was, why do you have like Brookfield and Blackrock in your portfolio? Because I always keep talking about the fact that it's super important not to have duplicates in your investments. And duplicates are companies with similar business model that would be affected by the same market event and would react the same way. The classic example I can give you is if you have 30% of your portfolio invested in Canadian banks and we have a mortgage crisis, well, guess what? They are all going to react the same way. The same thing as if you are heavy on technology and we have a AI crush, well, then all your AI related companies will go down accordingly. So it's more about a risk exposure and to benefit from the real power of diversification of having maybe a life insurance company, an asset manager, a payment processor, and then maybe one or two banks. Then you are a more diversified in the financial sectors because you invested in different industries. So there's that small difference here. So going back to the questions about Brookfield Corporation and BlackRock, well, it is true that they are two asset manager, but their business model is completely different. So for Brookfield, we are talking about an alternative asset manager. So Brookfield does not invest money into Apple or does not create ETFs. They do invest in wind energy, solar energy, toll roads, data centers, pipelines, hydroelectricity plants, all of those things. They are also investing massively in real estate, like big buildings. They also do private credit, private equity. So all of those activities are not related to the stock market per se. So it's a different way of investing. This is why we call it alternative asset management. And the key here is most of the time, those investments are less liquid. Think of buying a massive property downtown New York. Well, if you have to sell it the next day, not going to happen. If you have shares of Apple, of course, it's going to be super easy and fast to sell them. So Brookfield specialize in this type of long-term investment. So investment that requires a lot of cash flow and also requires you to let that money sit there for a long while. So when we think about BlackRock now, BlackRock is all about investing on the stock market. So they manage assets that are traded publicly, highly liquid, and a lot faster. They are also the largest ETF manufacturers. So yes, they are in the same industry, but their business model is a bit different. So that's the reason why I have both. The second thing is when I look at my portfolio, I have 5% of all my assets invested in Brookfield and then 3.70% in BlackRock. So altogether, we're talking about 8.7% for two companies that are a bit similar, but still a bit different. But they would likely, if the stock market, there's a crisis, they will react the same way. However, it's less than 9% of my portfolio. And as I explained to you before, my trigger for one position, for one exposure to risk is 10%. So when I combine both and I do not have any other asset manager, so then it still makes sense on that regards. Plus, there is a big difference between alternative and equity market. So for those reasons, I have two companies. Now, the other question that I found interesting was he listed a few companies. So you have like Fortis, Canadian National Railway, you have Moody's, Canadian Pacific, MasterCard, Thomson Reuters, Power Corporation, and WCN, which is Waste Connection. He was asking, well, how come those companies or any of those companies are not part of your top 10, or if you do not like, or do you have them in your portfolio? So that I found that very interesting in a sense where there are multiple great companies, and depending on your point of view, you may go for one and then somebody else may go for another. So that would explain that it's impossible anyways. Like, you have a top 10, you cannot have like a top 100, right? So you have to select 10 companies to be part of your top 10. You cannot have more than that. So that would explain why some of those are not in the largest position. I do have shares of Fortis and Canadian National Railway. The reason why they are not in the top 10 is quite easy. I tend to let my winners run. So Fortis and Canadian National Railway, same way with Canadian Pacific, actually, those are more like solid, long-term, kind of like anchors in your portfolio. They're like, you can call them like deluxe bonds, but they don't pay like a super high yield, but they show more stability. And I don't expect CNR or Fortis to grow double digit in my portfolio, as opposed to looking at Apple, Microsoft, Brookfield, Costco, Constellation Software, Visa. They all have that profile of growing high single digit to double digit returns every year almost. Even Couche-Tard, besides this year, it's been several years I have in my portfolio, and it usually brings in like a 5 to 10% return almost every year. National Bank, same thing. So of course, if I let my winners run, those guys are going to take the top 10 by default. In comparison, I can tell you that a few years ago, TELUS was higher up in my top 10. Now it's like the 10th position. And the way it goes, chances are Home Depot is going to beat it very quickly. So I have like TELUS at 3.27%, and then I have Home Depot at 3.16. So you can guess that maybe in a year from now, I won't be talking about TELUS about being part of my top 10. Doesn't mean that it's not in my portfolio. In the list that MNST suggested, well, if I have CNR, that doesn't make much sense to have Canadian Pacific, in my opinion. There are two railways. You have to pick one. In my opinion, both are great. I prefer CNR because my strategy is geared toward dividend growth, and CP has a different types of asset allocation, capital allocation, sorry. So with the recent acquisition of Kansas City Southern, and the fact that they do not typically increase their dividend every year, that's why I favored CNR. It's just to be aligned with my strategy. Similar thinking, Visa versus MasterCard, having both, they are like even more closer than Brookfield and Blackrock. So the reason why I went for Visa is I tend to prefer to go for the leader in a market, so the largest player. But again, MasterCard is definitely a great company. I did a review on YouTube not too long ago about both. I don't see the problem even owning both, but then I would consider it as one position divided into two stocks. As for Power Corporation, ironically, was the very first stock I bought back in 2003. But going forward, I got rid of it mostly because I see it as a deluxe bond. So stock price appreciation is nearly close to nothing, but you get a good dividend. The dividend is safe and it's increasing, but it's not perfectly aligned with what I want in my portfolio. I want more growth. So nothing against Power Corporation, but the lack of growth definitely is something. As for Moody's, actually, Moody's and other stock exchange or stock ratings related companies such as Standard & Poor's, or on the Canadian side, TMX, a company that we don't talk enough, they all show very nice dividend triangle, a lot of growth. So not necessarily a reason why I don't have it in my portfolio. It's a great company, just didn't happen to be on my radar. And I prefer to have like banks and Visa, and then I have like 2 asset managers. So at one point you have to make a decision in terms of your sector allocation. So adding Moody's or any other stock exchange related would just put too much pressure on that exposure to the financial sector. I would go probably like at 30% at that point. This is not what I want in my portfolio. And finally, Waste Connection. I mean, those companies are nearly perfect in terms of like moat, in terms of dividend triangle. Definitely on my list. I never pulled the trigger. I'm not too sure. I don't have like a real reason why, to be honest. But that's it. I mean, that's the reflection of having so many great opportunities on the market. It's hard to chase them all. And when I look at my top 10, I'm like super happy. And I mean, yes, of course, I could change Telus for the Waste Connection. That would probably be a good move. But besides this one, the others, I'm super happy. So it's just a matter of like finding the companies that you love and that you understand and that you're comfortable with. There are more than one good answer to that question, which is great. And this is why we have a market. So, all right, sorry for rambling for almost 11 minutes. So I'm up for the timer this time. I wish you a great weekend. Don't forget, next week, I do have a webinar, Dividend Income for Life. We're going to talk about companies like these. So on the 28th, so you can go on moosemarkets.com/webinar. We are close to get 1,000 registrants already. That's crazy. So we're going to have a lot of fun, a lot of questions. So I'm going to see you there, moosemarkets.com/webinar. And until Monday, don't forget to stay invested. Hey, welcome to the disclaimer. If you're listening to the Moose and the Loose, you cannot really expect me to give you buy or sell recommendation or financial advice, right? You're here for fun, you're here for information and some entertainment. But I am not your financial advisor, I am not your broker, so therefore I'm not liable if you're losing money after listening to the podcast. If you're looking for some advice, go see a professional. If not, you can enjoy the show and do your due diligence after it.